Hi, this is Pete Birchler of StockMarketAlchemy.com, and it is Saturday, February 9th. I wanted to give a brief update on several markets here. Look at a number of different charts. The first chart is the QQQ. So this is the NASDAQ 100. I've covered recently that there's a head and shoulders top formation here that has not been confirmed complete yet, but there is a topping pattern in place. Additionally, from a chart pattern standpoint, if we look at the trend lines of the move up since November, there is a rising wedge type of pattern present currently on the QQQ. So what I would expect in this case, what would be relatively typical, is for within the next couple trading days for prices to push up and touch or slightly exceed that upper wedge boundary, and that may end up completing the wedge. It looks like it's possible that we see another pullback and then another push to new highs as well, so maybe we will see that. But in any case, if we see any significant break of this, this post-fiscal cliff announcement low here, and we see a break of this lower boundary of the wedge, that could be an early confirmation that we have a top in place for this leg up, and maybe a time to establish short positions with already some price confirmation that the market may be making a high. Now, I wanted to look briefly at the S&P 500 here for a minute. Let's move to a daily chart with the ADX indicator, if I can find it here. There we go. So this shows the ADX on the S&P 500. So this is a measure of trend analysis. So when this is rising, the market is trending. However, that indicator will typically top somewhere around 40, or if it does move that high, the trend is well extended as far as the textbook pattern. So currently it's peaked around 37. What I think will happen here is we'll probably see the market begin to crack, maybe experience a correction into this week. Based off of the typical behavior of the prices relative to this indicator, I would expect a push to equal or new highs after that, but I think that could be the final push up as we have a correction followed by a push to slight new highs. That would actually end up creating likely some divergence on the MACD. So this is the Dow, and we can see that it's starting to cross down here, or starting to converge, but there's not any divergence. What would be more typical to experience is to experience a correction for a week or so, bringing that MACD into a sell configuration, and then see a quick break to new highs, and the indicator cross back up, but move to a lower high. And then if we see that followed by another cross down and a price turn down, that would be the ideal signal, is to see a divergence type of development like we saw back in this area in 2012, where it peaked, turned down, came back up, and then once it turned down again, then we were right near the final highs. So that's something to look for on the MACD indicator. What I wanted to look at on a weekly time frame is the MACD pattern in the indexes, and there is a pattern here that I have noticed several times in markets, and I don't know what will come of this here, but at the September high relative to the April high, we saw this divergence in the MACD indicator. However, price made a correction and has now moved to a new high. What I've seen happen sometimes is the MACD will rise again to roughly an equal level as the peak. So we may see it rise back to about that level and then turn down again, and it will create kind of an odd type of a divergent signal. So we'll have to see how that plays out, but it's something I've noticed. It's not a real textbook type of pattern, but I have seen from time to time on the MACD. Now let's briefly look at the recent commitment of traders data. This is showing the commercial net position into early 2013 here. So this is looking at the smart money traders. If they're net long, that typically means they expect the market to rise. If they're heavily net short, they expect the market to fall. Now, What we saw is an extreme net short, a historic net short position in September. And as the price corrected, they decreased that short position. And then as prices moved to new highs here in January, they initially sold back into that. But then what we've seen since mid-December is the last 6 weeks, the commercial traders have been actually buying while prices rise, which is not their typical pattern. Their typical pattern is to trade kind of inversely to price movement. So what I believe happened here is there was a large buildup of short positions, and then on this breakout to new highs, they were forced to cover those positions. However, what we saw this week in terms of the data is that there was a large jump or large net short increase here. So I take that to interpret that to mean that the short covering or the forced short covering over the last several weeks is now complete, and the commercial traders are ready to again begin to sell into new highs. So I think that this current price level, we probably don't have a whole lot of space overhead for the market to rise before it's significantly pressured by commercial selling into that new strength. And additionally, there's a divergence pattern continuing to develop here, which is relatively typical of topping and bottoming type of patterns in the COT data. Now let's look briefly at the US dollar index here for a minute, because I noted that in a recent post that it's forming a triangle. So this is a potentially powerful chart formation here, and I'm going to bring up the ADX indicator down here. Since basically the beginning of November, the US dollar index has traded in a relatively tight range here, and it's actually having some contracting trend lines as the boundaries. We saw a brief false breakout here on February 1st, and immediately price reversed there, and that was after it took out these two swing lows here from October and December. So that's actually a relatively nice buy pattern if one is looking to go long here, is to see kind of the stops support level broken and immediate reversal. Now, but there is no breakout of the triangle yet. So these lines here would project the price levels we would expect price to go to on a breakout. So if prices do move up here, that would be a breakout to the upside, and we would probably anticipate stocks declining. If there is a breakout to the downside here, we would probably anticipate stocks continuing to rise. Now, the longer this ADX is below the blue line, this 20 level here, typically the larger and the more powerful the ensuing trend will be. So the reason I point this out is that once we see the market start to move after a formation like this, we may see a very large price movement. They can be relatively tight and trendy, though that is not how it has been behaving recently, but nevertheless we could see a significant price movement on any breakout of this triangle pattern, as confirmed by this large prolonged basing pattern here. Now, the last thing I want to touch on are some foreign ETFs, because I believe that some of the foreign markets right now are telling as far as the future direction of stocks. I showed this as a ratio chart in the last post, but this is EWA, the Australia Stock Index ETF, and it's displaying a very nice, if we zoom out here, a upwards ABC type of pattern, and it's hitting into a harmonic resistance zone where this band of lines are here. There is some time symmetry in that there is a low to high projection that occurred within the last week or so here. And on the daily chart, we're now seeing this significant bearish divergence between the December highs and the recent February highs here. So if we do see stocks come and break back down these recent lows, that may be a good indication that there is a top completing in this market here. The previous post I made showed that the currencies of these commodity producer nations are actually weakening relative to the stock market, and that has presage declines in the equity markets of those countries. So right now, from a valuation standpoint, from the currency to stock market ratio, that would indicate that we're likely to see weakness ahead in these commodity producing markets. Now, this is the EWC, so the Canada ETF. It's actually failing to make new highs above that September high, and it's had a brief but mild break of this trend line here. What I think could potentially happen is we could see another push, possibly to slight new highs there. But notice that even though the U.S. Stocks made new highs here at the end of this past week, that this one did not, and that's going to be the pattern we're going to see in a lot of these funds. This is Germany, so this is EWG, and we have a significant sharp bearish divergence here as prices were rising into some trendline resistance, and now we've seen a significant price crack off the high, and despite U.S. markets being at new highs, some of these foreign markets barely budged here at the end of this past week. This is Hong Kong, which I don't follow as closely, but is starting to break down there. Now, this is Italy, and we've seen some very significant price corrections here in Italy and Spain in their ETFs. This also has an initial type of a 1, 2, 3, 4, 5 look to it on the way down. I don't read too much into that, but if we see a relatively slow correction or consolidation from these levels, that may be a shorting opportunity with a stop up at these levels. Given the volatility in those countries, there could be some very significant price movement. If we see a return to weakness in stocks, then a minimum target may be down at these levels here. So on a $13 or $14 stock, moving down to $9 is a very significant move. This is a chart of Japan. Japan's market is very correlated with, inversely correlated to its currency, and we've seen just some amazing weakness in the yen recently. But on the Japanese market, we're again seeing this divergence pattern. So it's broken out of this rectangle here and it's moving up, but it's kind of wedging higher in with a lower MACD. Given how oversold the yen is currently, it would be my expectation would be that we do see a top here in the Japanese market, and we see that decline as the yen turns back up for probably a very significant rebound in the yen. This is Spain, so this is EWP, and again there was a very significant price crack off of the recent highs at the end of January, and there was a relatively large-scale divergence between September and January if you look at the peaks on the MACD. So I would look for possibly any movement up here to be a selling or shorting opportunity in the future for that fund. This is France. France had been very strong over the last several months. Then it developed, if you look at the MACD, it developed a divergence pattern again between December and the early February highs, large gap down, significant price movement down. So given the look of these patterns here, I would say that a lot of these are set to continue to move down, and they are not confirming new highs in the U.S. markets. This is Singapore forming a triangle, could break out either way, probably to the upside on that one. This is the United Kingdom. Prices running into some overhead resistance, trendline resistance there. There is a nice low to high time frame pattern here. We have seen it initially kind of crack after a divergence pattern. So if we do see the market come back and trade below the low of this week, that may be an indication this market is headed lower. Lastly, this is that is South Korea, I believe, and then this is Brazil. Brazil, tends to be moved to some extent similar to the commodity-producing nations. It's been relatively weak. It's broken its trend line from November to January. The MACD is already in a sell signal, and the ideal time frame for that move up has already been surpassed. So if we do see any continuing weakness in this, we may see the market headed down sharply, probably to go below these recent lows. And if you look at a weekly chart here, there's a support level down here around 50 on that EWZ ETF. So if it does break that, we could see some considerable downside on there. So that's all I wanted to cover for this update, but I think a take-home message for U.S. stocks is that we're probably in the final stages of the advance for this leg up. We will probably experience a correction probably before the market reaches some of its typical median type of upward projections for legs up, and given the non-confirmation in the QQQ and the head and shoulders pattern, I think there is the potential for this to actually turn into a bear market. There are some other indications of some just very, very overzealous optimism in stocks, and that would also bode for a high being in place here. But in any case, over the near term, expect a correction, and after we see how significant the correction is and what the ensuing rebound would look like after the first next crack in prices, that will give us a better indication of whether we expect the bull market to be complete or whether we expect it to be another correction within a bull market likely to move to higher highs. That's all for this update. Have a great weekend.